Like, I don't know anybody who just downloads Realtor.com app and uses it. Any of my friends, at least, right? I don't know who's using it. Maybe old guys like Keith, but no.
Damn,
I'm kidding.
Shots fired.
That's probably going to be like the little snippet.
Yeah, there's the opener.
Use. Sorry,
yeah,
Keith.
Thanks,
Sorry,
John.
Keith.
Thanks a lot.
So, I've got more gray hair in my head than you do.
When James was talking about
Keith
new
did,
guard,
he just
Exactly.
When James was talking about old guard, new guard for residential real estate, I was trying to figure out which box I was in.
You talk about it privately, we talk about it publicly. This is the Real Estate Insiders Unfiltered Podcast. Welcome again to the Real Estate Insiders Unfiltered Podcast. I'm your host, James Dwiggins. I said it again.
You just say it so that I can't.
I just want to take the wind out of your sails.
Damn it.
So, and my famous co-host, Mr. Keith Robinson.
Yes,
so,
sir.
We had John Campbell, the managing director of Stevens, back on for our quarterly updates.
Love me some John Campbell with Stevens conversation.
I've done that so many times too. So tell him what we talked about.
Yeah, I nerd out when it comes to the economy and Wall Street. So it was a fun conversation. We did our normal rundown where we talk to him every quarter about the industry trends, who are the winners, who are hitting some headwinds. Then he threw out a crazy number with 50% of the agents possibly leaving the business. And then I gave him a counter narrative, and I might have even changed his mind. So fun conversation just to get a good update on market trends and Wall Street. Put it in your ears, kids. You're going to dig it.
John, welcome back to the podcast. It is earnings season, earnings reports. The thing that Keith and I totally get bored reading. John's like, yay. So for viewers and listeners to know, John comes on every quarter and does a rundown of all the publicly traded companies. I shouldn't say all, but most of the publicly traded companies in residential real estate. John, let's just start. So people who don't know you, 30-second overview of who you are, who you work for, what you do, so they have a little bit of context.
Yeah, sure. So glad to be back for sure. I'm John Campbell. I'm a research analyst here at Stevens Inc. Equity research analyst is code word for Wall Street analyst. So I cover a swath of the publicly traded, real estate related companies. We do basically everybody, but kind of the originators and some of the REITs and stuff like that.
Okay.
We cover title insurance stocks. We cover all the resi brokerages, or most of them. We cover Zillow, CoStar, used to cover Move, which is Realtor.com before it was acquired, cover Redfin, all these guys. So we got kind of a broad swath of the universe. Our whole approach is to kind of take the value chain. So like all these things are kind of interrelated. You look at something like Zillow, a decade ago was a internet-based company, right? And had all internet analysts covering it. And I think to understand Zillow fully now, you got to understand why they're doing mortgage, why they're getting in deeper into rentals and stuff like that. And they're kind of doing the housing super app, if you will, which is actually not a product. It's all those things together. I'm sure we'll talk about that at some point. People tend to get confused about that, but that's kind of the world according to us.
Got it.
Yeah.
Okay. So we've done now, this will be our second one that you'll be on, because obviously Wall Street gives out their earnings update every quarter. You come on after everybody's sort of done those calls. You go through listen to the calls, get all the feedback, and then, look at all the numbers and write your reports. By the way, we'll put a link inside the show notes if you want to get on John's reports. They're awesome. We do get them and send them around to our team. All right, let's move into it. So thoughts on the real estate market, economy, broader perspective on it. Obviously, jobs report was crap, depending upon what side of the fence you're on. Keith and I were like, woo! But so give us your thoughts and tell us what sort of Wall Street's perspective is. I know we kind of went up and down, it looked like, for a bit there. So
yeah. For sure. I'd say thanks for the kind words on reading the research, but like if you like reading the back of a shampoo bottle, that's it's fantastic.
I just read the first.
That's not that bad. It's not that bad. No.
I go more cereal box, the back of the cereal box while you're having breakfast. Yeah.
Yeah, totally. No, we do take pride in writing our research. A lot of times, Wall Street analysts are going to kind of just write up 2 paragraphs and be done with it and just kind of move on. We like to kind of do the intersection of all these companies and talk about read-throughs and kind of what the big picture looks like. So we do take a lot of time on that. But to answer your question, broader economy, how the equity markets, global equity markets are so focus on interest rates right now, that's what's moving everything, right?
Sure.
So every little economic data point we get is everybody's hanging on and trying to assess what that means, right? We've got Ukraine now attacking Russia. We have potentially, Iran that is potentially going to start a World War III. I mean, like, there's a big picture of things going on here. Now,
we don't care, though. We just care about interest rates.
Exactly. All right. And so, like, the market is going to, hedge bets. They're going to take positions based on certain views, and it's going to be advance of those views. And if it turns out that those views are not right, there's corrections, right? Big corrections. And I mean, like, I think of the latest I saw, Kamala Harris had actually either has crept up on the Trump lead or has either taken the lead. The market is absolutely positioned for Trump to win. Right. And those are two massively different policies, yet the market doesn't really care. Right. It's all rates. And so to answer your question on the economic picture, I think you're right. We have clearly moved from bad news is good news, right? Everybody wanted rates to go lower. So any kind of economic nastiness was like fantastic, right? Rates will go lower. That's not the case anymore. Good is good now. And you saw this last week. It literally triggered a global market meltdown, particularly in Japan. Japan, like, the market got wiped out. That's the worst move since like the 80s, right? And a big move here too, right? And, it was basically the unemployment picture, right? It came in with 35% fewer jobs. That's the highest level since, I think, 2021 on unemployment rates. Right? So it wasn't good. Now, fast forward to this week, 2 days ago, you got, you got the jobless claims that came in a little bit better, right? Now everything's fine again, right? But I was a little bit surprised.
Y'all are very emotional over there all the time.
It is very emotional, right?
Well, I think, correct me if I'm wrong, but it's been such a long run. And I think I remember debating soft landing, hard landing, all that, right? Like, everyone's just waiting for the other shoe to drop. And so that's a part of the sort of, I don't know, bipolar nature right now of markets is some bad news comes in, then it's the worst day ever. Then a little good news comes in. It's like, oh, whew, okay, we're okay. It's the best day ever, right? And it's just this volatility that's out of control. Like,
that's right.
Just relax.
That's right. And I've been the same way. It's seeing, like, you look at some of this from an academic standpoint, and, like, especially the housing market, like, how are people able to afford houses, right? And like the average American, I think they aren't, right? And you've got 300 something million Americans here and 4 million home sales. Like, it is only a select few that can actually do it, right? Yeah. I don't want to get into the conspiracy theorist stuff, but like the whole Civil War situation, there is such a massive disconnect here that it worries me, man. I mean, like, the American dream is to own a home. You don't want to rent forever. If you can't afford a home, and I was at McDonald's the other day getting my kid a Happy Meal, and I recognized the Big Mac was like $11. That is inflation. Right? Like, we can toy with energy prices and all that stuff and make the big picture inflation look better, but in middle America, like, the average consumer is getting walloped. Right. So all that to say, that does make me encouraged about U.S. housing in the sense that, I think home prices are, like, we're seeing the highest level of listing price cuts, right? That's a forward indicator. Clearly rates are going lower, right? We'll see, but it seems like that affordability picture is picking up a little bit, right? So we're encouraged by that for sure. If you look at just the market in general, last week or week and a half ago, the 30-year average mortgage rate dropped, at the sharpest rate we've seen since, the last 3 or 4 years on a week-to-week basis. Right. And I feel like that's just the start of it.
But it gave most of that back, right? Sense?
A little bit, but I think the mortgage market generally trades ahead of short-term rates, right? So it's kind of factored some of this in already, but I think there's potentially a lot of downside to mortgage rates. I think we could see that play out.
Sometimes people think that we need the Fed to cut in order to get downward pressure on rates, and that's just not the case.
It's not the case.
There have been times where the Fed cut, but not enough, and it put upward pressure on rates.
That's right.
So they are I'd say loosely correlative.
So
but
basically,
not
nobody has
causal.
any idea about anything. Is kind
Well,
of the point.
it's about what does the market
kidding.
expect, and
Yeah.
then what does the Fed do, right?
Yeah.
Like if the
Right.
Fed came out, most people I talk to, and my personal thought is the Fed's going to do a 50 basis point rate cut
I'm in that camp.
in September. I'd love your call on that.
Yeah. What do
But
you
if they
think?
came
What do you
out
think, John?
and didn't do a rate cut, that would be like that would move markets. And if they only did a quarter, that would also move markets, right? And maybe not in the direction we need or want.
What are you
Yeah.
thinking? You thinking 50 basis point cut?
I think so. I think the market's a little bit split on that right now. I mean, generally speaking, a couple months ago, even like there was an argument: are they going to cut rates this year at all?
Right.
Right. And then we went to 50 bips for the year, and then within literally like a week, it moved to 100 bips from the year.
Yeah.
Right. That was consensus.
Yeah.
And for anybody who's really going to nerd out and wants to look at the details, go to CME Watch Tool. Just Google that. That gives you a kind of
God.
an
He's got an
outlook of.
insight.
Right.
I'm going right now. You guys go ahead and talk.
Bye, Keith. Yeah, you go enjoy it. No, but like, I think 50 bips. Yeah, I think it's reasonable, right?
Do you think there's another cut coming after the election? Do you think they'll do multiple?
I think it's going to be contingent on the data.
The data, which everybody says, yeah.
Right.
Keith and I are in the camp that there'll be a second rate cut. By the way, we're putting that.
Well, I'm making some assumptions that there'll be that the jobs market. Look, well, I guess I should do this in the form of a question since we have our esteemed guest. Job market is cooling, though, right? Or is that
for sure?
Yeah. So long as that continues to cool, I mean, look, the Fed just can't get on a microphone and say, hey, y'all, we're going to lower rates once people start losing their jobs, right? That's a very unpopular thing to say into a microphone. Yeah, but the truth is we're going to lower rates, but we're going to lower rates once people start losing jobs.
Right.
And that's starting to start. How's that for a hedge? And it just depends on how aggressive that gets in the next few months.
Yeah.
All right. So we've got a rate cut coming. We're all in that camp. Potentially 50 basis point. Everyone's split, but some type of rate cut's likely happening. Again, dependent upon data, which is what the Fed says. All right. So we just went through Q2. So who's the winners in
who are the winners?
Yeah. Talk to us about the winners in this group, and then we'll go to the people
we should probably do some sort of disclaimer. None of this is investing advice. John Campbell is super
I should
smart.
probably do that myself.
Yeah. None of this is investing advice. Please don't make decisions. This is just one really smart guy and two idiots having a conversation. We'll let you figure out who's who. All right, go ahead, John. Who are the winners?
Yeah. And if you're going to sue somebody, go to James, not me. But
anyone but me.
No, I'm already in a lawsuit, so I've got no money left. So like, you can sue all you want. It's not going to change anything.
No, I'm kidding. One thing I would add, this is a bold statement: a recession's good for housing, and like potentially, I wouldn't say deep recession, but like the Fed's going back out and buying treasuries is going to bring rates even lower. Losing like unemployment, job losses is going to drive new listings. Foreclosures will absolutely drive new listings. More listings takes down price.
Right.
Rates go down.
There's pain with that along the way, but the point is the prices will come down potentially.
That's right. And I think what I was saying earlier about 4 million home sales versus a 360 million population, it's already like isolated to those who are probably more white collar and desk jobs. Right. And it's not construction workers. It's not frontline employees. Those are the individuals who on the net are going to be less impacted by a deeper recession. So I would just preface it with all that.
Yeah. Although I do look at construction employment. When I've done it in the past, it's been a pretty good leading indicator to,
for sure.
Yeah, so that is a number worth paying attention to.
That's right, because the cost of debt is going to absolutely drive the dollars of capital that go into construction, which then lead to the employment. Right?
Well, and builders, it's hard to get good trades, and so the last thing you want to do is start firing your good tradespeople. And that's so right. if you get to the place where you're terminating tradespeople, then there's more pain coming. Yeah,
that's it. Okay, so to the fun stuff, right?
Yes, who won? Who are the winners?
Here we go. Zillow, clear winner. Stock absolutely torched it after earnings. Stock's up 20% post earnings. It's up again today. When you see stocks have big moves,
were they profitable? Is that why?
Depends on how you define profit.
Well, I define profit as we made money. How do you define
Yeah.
profit?
So remember from a gap standpoint, right?
Here we go.
From a gap earning standpoint,
Uh-huh.
the non-cash items, depreciation, amortization, without getting into details, you buy something big or you do software or something like that, you pay for it up front in cash. And then from accounting rules, you have to recognize it a little bit. It's a nothing cost, right? You take out a lot of those nothing costs. It is profitable, right? Yeah. It is cash generative, is what we'll say, right?
Cash generative.
There you go. That's a different way to say it. Right?
I'm gonna tell Kayla that next time.
Yeah, exactly.
I mean, we're cash generative. We just can't go shopping right now.
So Zillow. We have been a very big bull on Wall Street with Zillow for the last several years. We have seen some of when they talk about these enhanced markets, they talk about their super app. They've invested heavily the last couple of years and kind of rewiring their systems, right? You all know the move to Flex, the mortgage, Zillow home loans opportunity. They put all those together in these enhanced markets, right? And when they say enhanced, it means all those systems are tightly integrated, all those products tightly integrated, and they're rolling it out, right? And most of those all those enhanced markets take away that market-based pricing, the legacy model where you buy, a portion of a zip code up, and they move it to Flex. And so,
which is more profitable for them.
It is by a lot. Yes, it's more volatile, but very, very profitable for them. And it also helps drive up attach rates to mortgage and all that stuff. And so we've been really pushing on this hard. They've invested heavily over the last 3 years. That investment is now basically done. So it's kind of in the numbers. So if you can grow the revenues, that's what we call incremental margin. You grow the revenues, the profitability on that. Every dollar that comes on after that is massively profitable, right?
Is it a oversimplification? I mean, the biggest change, at least, and I did not look at it with the same level of specificity that you do, but they've had a big uptick in mortgage capture.
Big time.
And
big time.
Is it an oversimplification to say the app is progressing, but big uptick in mortgage means more profit? Yay, Zillow, raise share price.
That's literally
too simple.
That's part of it. There's other elements to it, but you're exactly right. That's been part of our push. Is they look at this on a transaction, like they want to gain transactions, but they want to see higher revenue per transaction. And by per transaction, that one consumer coming in and doing multiple things. Right.
Wallet share or whatever.
And we did an analysis. We did a deep dive. So the CFPB now, over the last several years, has been capturing mortgage data. And they do this because they get all the data on every single mortgage, right? You have to report it digitally to them. So there's a massive database that they turn over to consumers. You can go look at it. It's free. And they did that because they want to look at discriminatory practices, stuff like that. If you're originating all to certain race or whatever, like they're going to look at that kind of stuff, right? For us, we can drill down to the zip code level or to the MSA level, and we can see what Zillow's doing in all these markets. Their mortgage originations and their enhanced markets, right? That's Atlanta, that's Phoenix, that's Charlotte, some of these markets. Their share in those markets was unbelievable. Like how much they've grown it. That's the first time I've seen evidence, because Zillow, anybody who listens to earnings calls, it's all like a lot of it's conjecture. Well, we're doing great here, we're taking share, but sometimes you can't really see it fully. Like you could just tell from their excitement, they're really happy with what they're seeing, but these are pilot markets, right? Not enough to move the needle.
I have a question, John. Just because we've heard a lot of this. This is not passing judgment. I'm just asking the question. A lot of the reasons that I've heard from Flex agents is that Zillow is being pretty aggressive about the fact that you need to attach mortgage if you want to continue to receive leads.
100%.
Whoa, can you do that?
I was going to say like that.
From well, they're not.
My question's going here.
They're not employees, right? And they're not really connected to the Zillow brand. I think the language they use is when they think about flex criteria. Now think about this: Premier Agent from 2016, the agent count is down, I think 60%. Right. This is because they're not dealing with certain.
Yeah, they're pushing it to a specific group of people.
That's right. And so part of their criteria is like customer satisfaction scores, the ability to close transactions on time, the ability to follow up on leads on time. The other one is you help grow your business alongside ours.
Yeah.
That is code word for do the
No, I
work.
get it, and I'll just be more direct since I'm one of the hosts on the podcast. I'm
Yeah.
worried
It's gonna be
about I'm worried about obviously RESPA violations because it's very clear what you can and cannot do, and a thing of value. I'm using the exact terminology, by the way, is what's classified where it crosses over. So I'm just asking this question. I'm not again ragging on them because if they've got a secret that they can share with the rest of us on how to
Yeah.
do this, we're all fine. But I worry that that thing of value gets looked at, especially by this administration. Are you guys looking at that at all? Are you
I
factoring
think
that
it's.
in?
I think it's too fuzzy to be able to, because like it's not an illicit kickback necessarily, right? It's not a dollar. No dollars are exchanging hands,
Right.
Right.
Yeah.
So if it's a bartering transaction, does that fall into that? I don't know, right? Because I know you got mortgage guys. All your agents have mortgage guys.
And it just
sure
depends
there's
upon what level of risk you want to take. You can talk to RESPA lawyers and they'll give you a risk level of 0 to 10 with what it is.
Right.
I don't want to fixate too much on this. I was just asking the question.
Yeah.
One question I do want to ask also, because we have a lot of companies to cover, since they're moving this to this flex model, how is Wall Street treating this potential August 17th forward I guess let me ask this. Are you factoring in that you think agent comp will come down on the buy side of the transaction?
Oh, for sure.
Okay.
Sure.
And does that affect your valuation on the companies that are highly on the referral based business?
Zillow, a couple different things. On a per transaction basis, Zillow is probably going to go with the buyer agent and get less in certain instances with flex, right?
Yeah.
I think that's
the
fair.
downward
That's fair.
pressure affects them just
too.
like it affects anybody else.
That's right.
If you're on
Zillow, from an app usage standpoint, Zillow is doing 3 times more than in any of the other portals, right? It is touching almost everybody who goes and transacts at some point, and they're doing 3, maybe 4% market share touching of those transactions, right?
Got it.
I think part of the issue for Zillow is that they have been boxed out in certain areas in the industry. I think a lot of these industry changes, this could be a whole nother podcast, but a lot of these industry changes, I think, are going to make their value to the consumer go up, right? There's going to be a void left in the market somebody's got to fill. I think Zillow, its value proposition actually increases, which then increases transactions. So on a per transaction basis, dollars go down, way more transactions. It's a net positive for Zillow.
And then obviously attach rate on the other products. All right. Just
one more follow up, just
Sure.
On any portal, right? With the whole country now going to buyer representation prior to showing.
Good question, Keith. Yeah.
Right.
Yeah.
Do you feel that impacts the portal business?
A positive.
It's a net positive.
A positive. So I actually asked that question on the earnings call.
Did you really?
It's a good question.
Yeah.
Their new touring agreement basically helps further, because one of the problems with Zillow, and any of your agents, anybody out there who's listening to this who's bought leads from Zillow recognizes that the conversion rate on that's outside of Flex is low.
Yep.
So you're wasting time with a lot of those leads, and sometimes the ROI is not clear. And so I think it would actually benefit Zillow to reduce its lead flow and get higher intent lead agents, right? Higher intent leads, right? And I think signing up to go see what your grandma's house looks like after it sold 20 years ago, just for fun because you're bored over the weekend, that's a waste. You're wasting an agent's time, right?
So you're weeding out people by deciding whether they're actually serious or not. So,
this is a little bit more serious now, right? And you're also informing the consumer, and you're taking a role early on with your form as part of the transaction. You are helping educate.
So lead volume goes down, but lead quality goes up. And
Bingo.
Since you've moved towards Flex anyway, the net effect is positive.
Bingo.
All right. Other winners.
I think Redfin, stock was a little bit weak off the print, but it's come back last 2 days. We upgraded Redfin back in May. The only analyst out of 19 analysts with a buy. It is very negative out there. I think Redfin's turning it around. This Redfin Next initiative, which they are now announcing they're going to roll out basically across the nation, I think is a massively big deal. As you guys know,
Just in case people don't know, what is Redfin?
Yeah, Redfin Next. So everybody knows Redfin has been unique in that they have the W-2 salaried agent model. The problem with that is there's a fixed salary, and it's a cyclical market that is highly seasonal. So you get screwed. So you have to be able to perfectly forecast, right?
Sure.
Because if housing bounces back,
consistent.
right?
Yeah.
Exactly. If housing bounces back and you're understaffed, you lose share.
Yeah.
Or if you're overstaffed, you lose margin, right? So they finally are saying, okay, you know what? Forget that salary. we're going to go to a split, right?
Oh,
And I
you
think
mean like everybody else?
yeah, exactly. Right. Maybe there's a reason you should do it like that, right? They've had these grand visions of being able to be much higher margin. I think finally it took COVID. It took interest rates going bonkers.
So they're going traditional,
Yeah.
basically.
They're
is
going
what your point
traditional,
is.
right?
Yeah.
Now, where that's different for Redfin, that's super interesting, is you still are a W-2. You get salary, or you get benefits, right? Which are kind of unique at 401k, healthcare. You get their technology, which you can argue whether it's good or not, but it's essentially feels like it's free. You're not paying somebody else for that, right? There's no CRM charge for you each month. And then maybe that one of the biggest things is you get leads, right? We look, there's a multi-billion-dollar market cap company in Zillow because why? Because people buy leads, right?
Yeah.
So they're supplying you with leads, and maybe you don't want the leads. We'll just continue closing business at the rate you do. Now, they're not going to give you 90% splits like a lot of high-producing agents get, right?
Sure.
But there's enough where there's an offset of not having to pay
You can
for
make more
healthcare and
money
all that
because
stuff.
you're able to charge what you want to charge, correct? Is that the difference? The agent can go out and charge a fee of what they want to charge.
Yeah, if I'm brokers, brokerage in their area and some of their top markets, like that maybe worries me a little bit. They've got 1,600 agents, right? EXP and Real Brokerage are adding, or EXP used to add that amount in a month, right? What does this Redfin look like with 10,000 agents, right? It's a totally different animal.
Sure, it's interesting.
Yeah, everyone
comment.
freaks out about Zillow, who has, to date, shied away from being a formal brokerage. I know they're in your MLS. Relax, listener, relax. Okay, there's not Zillow signs in yards, right?
Yeah.
But Redfin is actually a broker. Like they're transacting
Very
residential
much.
real estate, and no one ever gets mad at them.
Yeah,
It's weird.
Because they're small. 1,600 agents, you just don't run into them much. But again, that 1,600 could look a lot bigger.
Interesting.
16,000.
Okay,
Yep.
so who else on the win side?
I think EXPI is, they're losing agents, like it's down year over year. But this is, remember KW a couple years ago, like just crushed or took out all their phantom agents out of their agent count.
Yeah.
Right. Guys who've been in there forever, hadn't closed a transaction. They might not even be alive.
There were a couple dead ones, as I recall.
And so, excluding that, and part of the reason EXP has done so well is that's been a KPI, a key performance indicator. Like people see the agent count growing, these big long-term growth guys, investors are like, oh, it's taking care, blah, blah. So when that went against you, it hurt the stock, right? But from a actual revenue and earnings standpoint, they're doing fine, right? They're still taking share relative to the national market. And I think they've been, and kudos to James again on this, but I think they've been like James. I think Leo, the CEO, has been out in the market and is willing to take a stand.
Smart guy. I know him really well. We're good
very
friends.
smart guy. He's one of my favorite guys in the channel.
Yep.
And I think they've been willing to step out. I'm not going to name names of some of these other public companies and even private, but some people are hiding, and it's shocking to me. In moments like this,
Actually,
leaders
were
lead.
hiding. Yeah.
Almost all of them. I think you're right. And they're like, well, we'll just wait to see how it plays out. I'm like, oh, okay. That's a terrible strategy.
And just a plug, Leo will be on our podcast coming up soon. So everybody pay attention to that.
Tell
one.
him I said hello.
So, all right. So I have one question for you though. So this is just, again, relevant to August 17th. A lot of people are forecasting agent attrition across the business. Keith and I have been pretty clear. We think numbers somewhere between 20 to 40%. To be clear with that, this has already started over the past 12 months, our numbers, just for clarity. So
I'm not at 40, but
I'm on the 40. Keith's somewhere lower than that. But the point is we've got some attrition that's going to come our way. What's your take on that? And then how it affects all of us, technically, all the companies?
Oh man, I hate to say this, but there could be a base case of 50%.
You think 50% of agents go away?
Now,
can we bet that?
I used to not think that.
Shit, John, I don't have any freaking whiskey in my tea this morning. That's like
no.
Sucker.
These are not your agents. These are not your agents. These agents, a bunch of them are at EXP, a bunch of them are at Real Brokerage. These are guys who are new to the industry, have zero transactions. When Mike Del Prete, and God bless him, he's a brilliant guy. I love the data stuff he puts out. When he at Inman last week or 2 weeks ago.
You about to shoot shots at Mike? Let's go.
No. This is good. This is good. This is actually, this is really good. And I'm going to collaborate with Mike on something around the Zillow in the future. So look out for that. But when he said that the median transactions, right? Remember, not me, not the average, the median, where it sits in the
middle. Yep.
is zero transactions. What does that mean? You got half of the industry who doesn't do anything. They don't close anything. They just have a license. I don't know if that's 0.4 is zero or if it's actually zero, but like, why would you stick around, right? Why are you paying NAR dues? Why are you doing any of that stuff? I think you just kind of hang a license and just wait. So maybe it doesn't drop 50%. A lot of them just kind of stick around, but they don't matter. They're not doing anything.
I'm going to let Keith respond to this.
Let's hear it.
Well, no, because you have an opinion. You have a strong opinion on the fact that people are analyzing this wrong to a certain degree.
Educate me, please, Uncle Keith.
I think, look, obviously there's some percentage of those 0 or 0.4 agents that are going to go away. But that's always been true. I don't think, right, they've cycled in and cycled out. It's always been a boom bust growth. I think we're headed into a real estate recovery, which tends to bring more people into the industry, not push people out of the industry. And then most importantly, a lot of those, what I call hobbyist agents, with no disrespect, right? But they do a couple deals a year. They don't,
or even one.
They're not the primary breadwinner for their family, right?
That's right.
And so they want to run around town with a business card, and we make some extra vacation money. We make buy a new car
That's
money.
A really valid point,
right? And those people in mass won't exit the industry. I don't think the risk point and this is less about Wall Street, more about our industry, is there's sort of this natural evolutionary cycle of a real estate agent. And there's a spot around year 2, year 3, year 4, depends on the talent level and market and a bunch of other things. But where you're getting by, but you're the primary breadwinner for your family, right? Or for yourself. And there is going to be downward pressure on buy side commission. And if you're a hobbyist, great. Instead of going to Fiji, you go to Hawaii, right? You just ratchet down whatever you were doing with this extra money.
Fair.
If you're paying your bills, actually paying your bills with this, then you can't afford to stay in residential real estate. And then we gut the talent in that what I would, if we're calling real estate talent an emerging market, right? Some good people aren't going to make it through this that we need for the future of the industry. So I actually think that sort of top of the bottom quartile, bottom of the second quartile agent is the most at risk versus the hobbyist or low producing real estate agent.
So think on that one, because he's got, we were talking about this, obviously, even internally, we're going, okay, who's at most risk? And we're sitting there going, it's our, we call middle America, the ones that are, in there full time trying to make a living on it. We've got 15 minutes, so I'm going to do this more rapid fire fast.
Sure.
Give us the ones that you're concerned about. So hit us down that list of.
We can't call them losers. The other ones were winners.
No, we don't want to call them. It's a tough market. So who are the ones you're not bullish on?
Yeah.
So.
And Keith, you just sold me on that. I'm kind of with you there.
Yeah.
So let me take my 50 down.
He's got
20, 30. Yeah.
He's got some research in that. Like there's some validity in what he said.
I'm not just a pretty face,
so,
John.
Yeah.
I'm not just here for my
You
looks.
are pretty though.
I am.
Yeah.
I mean, I didn't say I wasn't. I'm just not just. All right, let's get back to it.
Okay. Who are the not losers, but kind of not winners, right? Remax to me feels like it's challenged, right? I think you have older than average population base, agent base. I think you have, which is great. It's highly, highly tenured. So if I'm thinking about this near term, I do think they'll probably hold up better than most, right? They're going to have more pros to negotiate who can better protect commissions. And on the earnings call I was on 3 hours ago, some of these analysts ask questions like, what are you doing as an organization to help protect commission rates? Like, dude, don't throw landmines out here for these guys to step on. That's silly, right? But I do think from a long term, like if I'm an investor and I've got a 5-year horizon, like I do worry that like their agent declines that has been steady in the US for the last 4 or 5 years just continues to the end of time, right? Because part of the issue with Remax is if you're a hobbyist agent, you're not going to pay, you got to pay monthly dues to them. You got to pay NAR dues, but you also have to pay monthly dues and continuing franchise fees. And like, you have to be able to close a certain threshold to be profitable, to even be on their platform. Right. So again, because of that, it's going to help them near term to deal with the market turmoil and the changes, but longer term, I don't know, it feels challenging to me. And they also have a debt. Debt on the balance sheet that feels a little bit tricky. They pulled their dividend. That was one of the hallmarks of the Remax story. Consistent agent growth over time, so steady earnings.
Sure.
And then you had the dividend, right? All that feels kind of shaky now. And you've also seen them kind of backtrack on, we're going to be a technology provider. We're going to be a technologist, right? We're not going to outsource. And now they're at, inside real estate, right? And giving up a lot of that stuff. So that one feels a little bit challenged to me. From a stock standpoint, it feels washed out. It feels like it's kind of protected. Like this quarter was the first time they grew earnings in 2 years, despite continued revenue growth and agent count down. So they're at least cutting to greatness, right? They're cutting back to earnings. So we'll have to see on the outlook from here. Anywhere is the other one. I just, from a stock standpoint, I just struggle to see any kind of catalyst. They all, back from when they were acquired by Apollo, through a leveraged buyout many moons ago, they're like the debt that was put on them, right? 11 turns, on the debt coming out of the crisis was like, oh my God, how does this thing survive? Kudos to that management team, though. They've done a fantastic job.
Yeah, cleaned up a fair bit of that debt.
Big time.
Yeah.
Ryan is a smart dude, and he's also a killer, right? Yeah. Ryan is he's a badass. I like Ryan a lot. And their CFO is one of the most unheralded, underappreciated. She's fantastic as well, Charlotte. But they still are having to deal with a lot of stuff that was put on them before they even thought.
Their business model is the biggest. I just keep going. They've got the same business model from a pricing perspective, like what they charge, and I just worry how that plays out long term, especially with all these changes coming, because if agents are making less, one of the things I guarantee they're going to do is they're not going to want to pay as much. So
this is common economics. When you get shaken down, you go to the guy behind you, right? You're shaking down, and they're the guy at the end of the line, right?
Right.
They're going to get flipped upside down, and
just to steel man the other side, though, right? Just because podcasts are boring if all three of us agree. They still do something like north of 20 to 25% of all the transactions across the U.S. run through one of their brands. You could build a story, I think, where if they could shed their debt and continue to do the work that they've done on their debt and get a little more innovative, that's if you want to talk about a beachhead play, like having 24% or whatever of all transactions in the U.S. come through your brand. Once you get your shit figured out, you could do some interesting stuff with that, right?
That was the Cindent idea, right? Yeah. When Cindent put all these businesses together, including Cardis, like a relocation business, and the idea was that was kind of the value chain, right? You could cross-sell everything. I think that was working for them, but they were forced to, because of their debt. What did they do? They sold off the title. Yeah. They tried to sell Cardis, right? That fell apart around COVID, right? They've had to make some really tough decisions, right? And that's, again, because they were saddled with all this debt issue from many moons ago.
I guess clean up the debt, but you could build another title operation that's not like wildly expensive or hard, right?
Getting it scaled is, but
to be part of you could force it like Zillow. No, I'm just kidding. Scratch that.
All right. Yeah. So we covered anywhere. Let's go down a few others here, and then I want to end on CoStar Realtor, because I think that's where a good ending point could be. We've got Compass, EXP, and Fathom. Go down those really quickly on your thoughts on each of those.
Fathom's yet to report. Well, we can start there. They announced a new agent pay program. They've changed that multiple times. That's one where you're talking about a 40 or 50 million market cap company. It's gotten tiny. It's not investable for a lot of investors. So that's like a kind of a little bit of a TBD. I think they've been talking about what they call walkovers, which are independent brokerages coming over and converting, right? EXP saw that as well. I think Remax talked about that today on their earnings call. It's happening, right? You're looking for safe havens, right? Sure. So I do think that when you think about consolidation, it's not so-and-so announces huge acquisition of so-and-so who's also large, right? It's those nickeling and diming of
it's the real estate's version of quiet quitting. Right.
Yeah, that's it. And looking for a safe haven, right? I think that's it. So that's one. Compass, man, I think Compass has turned it around from the cost standpoint. Like when we look at this from Wall Street standpoint, they were trying to be too much of a technologist, right? Their past chief technology officer, Joseph Faroche, came from Microsoft. He was a big, heavy hitter. They led with him on the IPO. When they went around to all the different markets investors, he was the central guy. They tried to talk to monthly app usage and blah, 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 and the platform and like investors didn't buy that, right? And so they cut out a ton of software development costs and stuff like that. And then they fired Shrosh. That was like killing of the golden goose. That was a big moment for them that, hey, we're serious. We're going to drive profits now. We're going to try to get to free cash flow positive and start driving profits. They're well on their way. They're doing a great job. Free cash flow is picked up. They grew revenues pretty nicely this past quarter, grew agent count. So it feels like they're in a good spot. And opposed to like an Anywhere, I do think that their brand resonates more with high-end producers. Like they do kind of carry that luxury where it feels like it's cool to be part of their club.
Yeah. Okay. And then Real?
Real Brokerage is a total breakout story. I think they have a fantastic management team. I've always liked them a lot. They remind me a lot of EXPI a couple years ago.
Sure.
And I keep saying EXPI. That's ticker language.
EXP.
You know,
Ticker for
stock
EXP.
ticker. Yeah.
You know what I'm saying.
Yeah.
But stock's up almost 300% year to date. Their transaction volume in 2Q up 80%.
Yeah.
Right. Industry volume up, I don't know, 3.
Yeah.
Agent count up 70%. They just hit 20,000 agents.
Yeah.
Mm-hmm.
Yeah. Sharon's a badass, by the way. And
he is a badass as well.
He's a friend of Keith's and I's and has also been on the pod.
Sure.
You can see what's interesting is you can see sort of the next evolution of real estate companies coming out because of the leadership. Like to me, there's like new
100%.
and then old guard, and it's becoming a very clear delineation between those philosophies. If you think about Leo and Sharon, they're out there, they're visible, they're in the field, they're
100%.
they're literally out there with their people, very little ego. Like you're noticing a trend between that, and then obviously you're noticing the growth of the companies. So
that's right, and I think that part of their success is obviously because of that. And I keep saying, I think a lot of these industry changes are going to flesh out a lot of the junk, right?
Mm-hmm.
Weaker agents, I think weaker management teams, like the cream will rise to the top.
Mm-hmm.
And when you've got 4 million home sales and 1.6 million realtors, that is way oversaturated. Could be potentially a good event. I think you're right on that front.
Okay. So we've got Real, if I'm reading this right, Real, EXP, Zillow, and Redfin are in your winners category. That's where you're Redfin not winner yet, but you're bullish on them essentially. So
yeah. And I think, if the market gets unraveled in a big way, and when it gets Ragnarok,
sure.
we start talking about MLS, having right, that's a Rob Hahn thing. So I totally stole that from him.
That was awesome. Ragnarok pull.
Right. If that happens, having 50 plus million unique visitors to your website and your brokerage is a very big advantage.
Yeah,
right?
for sure.
You're aggregating demand.
Yeah.
All right. 5 minutes left. We'll end on this. CoStar, Realtor.com rivalries certainly heating up.
Yeah. Clash of
and
the Titans.
It's out in the public, and two CEOs with very different opinions of each other and their companies.
John, what's your opinion on cage match?
That'd be
solving
awesome.
Right?
That'd be
Pay-per-view.
awesome. That would be awesome.
Yeah, okay.
Let's not condone violence, even though I completely agree with this, by the way. What's your take?
On August 17th.
Yeah, there we go.
Yes,
Yeah.
Distract us from the problems.
That's a
really good call.
Andy, Damien going head to head, 2 companies. What's your thoughts on all this?
I agree with Andy on this. That it feels desperate. I think Realtor.com is not really even part of the conversation. Part of that's they're not public, right? Or they're public within a much larger entity.
Yeah.
So they don't get much airtime, but it just feels like an old tired brand. Like I don't know anybody who just downloads Realtor.com app and uses it. Any of my friends, at least, right? I don't know who's using it. Maybe old guys like Keith, but
damn,
I'm kidding.
Shots fired.
That's probably going to be the little snippet.
Yeah, there's the opener.
Sorry,
Keith. Thanks,
sorry,
John.
Keith.
Thanks a lot.
So,
I've got more gray hair in my head than you do.
When James was talking about
Keith
new
did,
guard,
he just
Exactly.
when James was talking about old guard, new guard for residential real estate, I was trying to figure out which box I was in.
You're the tweener, right?
Yeah.
So I have a question for you. I posed this the other day when I was asked this question by a Wall Street analyst. Actually, I said, there's a lot of stuff coming down the pipe, right? We all know there's going to be a lot of changes. Let's say there's commission pressure, less agents, et cetera. There's 4 million home sales. and there's only so much money to go around. And so I have to ask this question, like, is there room for 3? Because let me just put it to you this way. Think of it this way. If everybody's moving to the sell side, for example, of trying to get listing agents to pay for advertising, and you've only got so much money to spend, and let's hypothetically say homes.com and even showcase listings are similar in concept, is there enough money to go around to make all this work? Like,
no.
3 portals feels like a lot to me.
They should have sold when Andy went and put an offer on them. They got aggressive and they said, we want this, and otherwise you're going to have to spend $1 billion to go build a traffic. And Andy says,
okay.
And Andy says, hold my beer, right? Here we go. And they missed it, right? Who else is going to buy them now? If you're private equity or if you're any other big, large entity, are you going to go buy them and get in this knife fight where these 2 crazy guys in Zillow and CoStar are going after each other and you're playing way from behind? I don't know.
So you think...
I'm with you.
Okay. So, and that's not to be offensive to anybody, because I mean, competition's always good in a market, in my opinion, because it helps brings costs down for the people that we serve. But are you of the opinion that there really isn't room for 3 and that there's enough room for maybe 2 at this point? Is that...
We can certainly have 3 portals, but we can have 2 winners. That's the way I'd put it. I mean, they're tucked under a massive conglomerate, right? And News Corp, where if they wanted to keep it alive for digital advertising and stuff like that, where Sherwin-Williams wants to advertise it, yeah, fine, whatever. But as far as being relevant with agents to the point where they're spending on your platform, I think no.
Interesting. Okay. Final thoughts?
It's interesting, man. I feel like right now, I'll say, coming away from Inman, I was surprised at some of the kind of more draconian views around commissions that are coming. And people are finally they're finally there. Yeah. Man, we do this quarterly agent survey. In the fall survey, we asked the question, what best describes your views on the ongoing industry commission cases, blah, blah, blah. And like one of the answers to the questions, it basically said like the extent you expect commissions to compress or whether there would be no change. One of the answers that we provided was what ongoing DOJ and class action suits.
Don't tell me.
There was a third of agents that said, I don't even know what's going on.
This is why I drank. That is why
but
I drank.
I say it now, and I guess given we are 8 days away from the event, people they're completely on board with it now.
Yeah.
But not only do they learn about it, but now they're like, oh God, it's going to be terrible, right?
Yeah, but that's a natural human emotion, right?
It is.
It's the initial reaction will be fear. And then you start to process it, and you start to develop the skills, and then the other side of it, and it's not usually the end of the world.
I'll give you an anecdote for us to wrap up on, just because we got to wrap this thing up. I was talking to a broker who 6 months ago decided that he wanted to try the offering no compensation to the buyer's agent, and just basically said, just bring your offers. Which, by the way, everybody started listening. That's how you do this, okay? Just everybody understands. So he just basically says, this is what I charge the seller, and then we're willing to entertain anything in your offer. Just submit it. 7 deals, except for one, which didn't end up happening as a circumstance. In every single scenario, the seller ended up negotiating and paying compensation for the buyer's agent. You know why? Because they want to close the damn deal. They want to sell their house. Right. So it was interesting. I'm not going to share some of this stuff because we might have him as a guest. We're still going through some of that stuff, but it was interesting to hear even some of the numbers, because for what it's worth, and this was in California, there was no change in comp.
Yep. Yeah, I said this on the Inman stage during our panel session, right?
Yeah.
If you have 30% growth in your equity, giving up another 2 or 3% of that to get the deal closed, it's not that big of a deal.
It's a no-brainer.
So making this change right now with that as a backdrop, it shouldn't be that scary.
That's a great point.
Yeah,
actually, I hadn't considered the peak home equity. So.
Yeah.
When you feel,
and it's play money, Keith, because it's equity. You didn't actually have it in your bank account. So you get this massive check. It's like, well, in the grand scheme of things, I want to get this deal done. So, all right, John, my friend, thank you for being here. Always insightful. Always good to hear your feedback and thoughts. and we'll have
Thanks
you
for
back
doing
in another
this
few months. So
on
Yeah.
earnings week too. I know,
My
it's
pleasure.
a crazy
Time
week
out.
for
The
you.
bags in the eyes, the red eyes.
I
It's
know.
real. This is not some kind of glitch in your.
I owe you a
In the
cocktail
Matrix.
again.
I'm glad I made it through.
Yeah,
Good.
I'm gonna pass out now.
Appreciate you, brother.
We'll see you in another quarter. So
Yep, sounds
all right,
good.
buddy.
Thanks, guys.
Talk to you soon.
It's our job to say out loud what everybody's only thinking to themselves. It's your job to subscribe to this podcast so you never miss an episode.